Hello and a warm welcome to today's webcast. My name is Matteo Schmidt. It's a pleasure to host you. It's really great to see how many people signed up for this webcast. This is our first public webcast. We've done a couple of private ones for our investor community already, but this is the first live public webcast. We're going to record it, so if you want to rewatch any part of this webcast in the future, you'll be sent a link to the webcast again, where you can watch it again and rewatch it as many times as you like. If you have any questions, feel free to ask them on the right-hand side. There's a little box that says Q&A. I'm going to answer your questions hopefully after the webcast or follow up via email. So feel free to ask any questions also during the webcast. As you probably notice, Maxi Köhn is not going to be part of this webcast, unfortunately, due to personal circumstances. He'll be part again of the German version of this webcast. So if you do speak German, feel free to join that one as well. Content is going to be the same, but you'll see two friendly faces instead of just one. So today's topic is going to be real estate investments in times of rising interest rates. It's, I think, a topic that has been quite frequently discussed in the media over the past 3 to 6 months. I mean, rising interest rates are just everywhere, basically, and you hear a lot of talk about supply chain issues, about rising construction costs, labor shortages, and all that kind of stuff. Inflation, of course, that plays also into the picture. So today is going to be all about that. And I think a good starting point is a question that we get asked quite frequently by investors and by partners alike that say, look, the ECB didn't raise any rates yet, right? It's still at zero. So all this talk about interest rates changing, I don't see that. And I think that is a really interesting point to make, but it also misses the point in the sense that the ECB rates are just not applicable to the real estate industry. Because if you think about it, a bank's business is essentially, or the traditional banking business is borrowing money at rate A and lending out money at rate B. And the spread between the two is what you earn as a bank, right? Now, the rate at which you borrow the money is not the ECB rate, but it's rather a swap rate. So if you look at the swap rates, that is what's going to paint you the picture of the true cost of borrowing for the real estate industry, and especially for mortgages. Those rates that we're showing now are for euro. Sterling rates are obviously going to be a bit different, but the trend is going to be the same. If you look at it, 5-year rates back in December, so just 6 months, we're now 6 months later. Back in December, the rates were at 20 basis points, 0.2%. Now we're at 1.4%. Just 6 months later, 6 months into the year, rates have increased sevenfold, so 700% increase in the swap rates for a 5-year euro swap. On the 10-year side, which is even more relevant to the mortgage market, because most people in Germany finance based on 10-year rates or fix their interest rates for 10 years, went from 40 basis points, 0.4%, to 1.8, 180 basis points. That is nearly a 5-fold increase, nearly quintupled over just 6 months, 500% increase in those rates, right? So those are big numbers. Those are big moves in the world of interest rates that we've been seeing just in the past 6 months. So just as a recap, ECB didn't change, but that's not relevant. Relevant is the swap rate, and those rates changed massively. And how do the swap rates translate into the actual cost of borrowing for investors or borrowers in general? It's fair to assume a bank has around 50 to 100 basis points of spread over those swap rates. So 0.5 to 1% on top of the swap rates charged by the bank. So on average, your cost of borrowing for a 5-year loan went from somewhere between 1% to around 2.5%. And those 1% were just the standard rates. If you were able to snatch a particularly good offer, you were able to borrow at 0.5% for 5 years. We've even heard of loans being written at 0.2% for 5 years, including the bank spread. So borrowing rates have essentially quintupled over the last 6 months. If you look at 10-year rates, what's your cost of borrowing going to be if you buy a flat now? It's probably going to be around 3%, coming from 1 to 1.5%. So that is just an immense move. That is a huge move, and that's definitely noticeable in the market for sure. I get that those numbers are quite abstract because, swap rates, what's that even, how does that translate into something tangible? Let me give you an example. I'm going to be doing a bit of calculations here, so bear with me, but I think it's really, really important to make this point. Think about a regular family in places like Munich, Berlin, Hamburg, probably buying around 100 square meters, 1,000 square feet of flat, right? So not really extravagant, not huge, not lavish, just a pretty basic 100 square meter flat in a sought after location in Germany. Probably going to be around newly built 800 grand, so 8,000 euros per square meter is the going rate for an average flat, for average new flat in those areas, Düsseldorf, for example, or Munich. In Munich, 8,000 would actually be quite cheap, so probably looking at Berlin or Düsseldorf or Hamburg, right? So 800 grand for that flat. You have 10% of additional costs like brokerage fees, taxes that are a big thing in Germany and all that kind of stuff. So that amounts to roughly 10% of the purchase price. So the total investment is 880,000 euros. Historically, people would usually finance the purchase price and then pay the additional charges or additional fees from equity. So that equals to around 10% equity commitment to a flat, right? So they were borrowing 800,000 euros to buy this flat. Back in December 2021, so only 6 months prior, right, you were able to borrow at 1%, pay a 2% amortization on the loan. So essentially you're doing a 3% payment on an 800K loan. That means your cost of owning that flat, or the cash outflow that you have for owning that flat, is around 2,000 euros per month, 24,000 euros per year. Now, 6 months later, for the exact same flat, you're paying 3% interest, 2% amortization, 5% on the loan, right? 3% interest, 2% amortization means 5% payment on the loan. 5% of an 800 grand loan is a 40K payment per year. So you're paying for the same flat, same location, same size, same appliances, same everything, 16,000 euros more per year. And that is after tax, right? So because interest on self-occupied properties is not tax deductible in Germany. So effectively, you're paying 16,000 euros per year more for the exact same flat just 6 months later. And that is how that move translates into actual costs for borrowers or for buyers of that flat. And if you want to move that argument further or make it even stronger and dive a bit deeper, those 16 grand are after tax. If you assume a 45-50% tax rate in Germany, which is probably applicable to that household, you end up around 30,000 euros that you would need to earn more per year to afford the exact same flat. 30,000 euros. The average household income for a family buying such a flat is probably somewhere between 100 and 150,000 euros. Okay. Now you need to make 30,000 euros more, which means you would need to make 30% more in just a matter of 6 months. So I'm imagining like me calling up David, who's the CEO of LINUS, so essentially my boss's boss. Me calling up David saying, like, look, David, I need more money. I need a salary increase of 30% just since January. That is probably going to be a tough pitch, not because I'm not doing a good job, but because asking for a 30% salary increase is quite something. And I imagine that's going to be the same for almost everyone in that situation, for almost every one of those buyers / households that was looking to buy a flat in December and is now looking at essentially double the cost for borrowing or for owning that flat as they were just 6 months before. So that is how those rates translate into actual life, into that shows the actual impact it has on people's lives. And of course, that is going to translate into buying behavior or demand for those properties, right? Because less people are going to be able to afford those flats because their income side isn't as flexible as the cost side, which is closely correlated to the interest rate development. And another argument that we often hear is people saying, yeah, I get that interest rates have been rising. However, if I look back at the 90s, they're still incredibly low, right? So from an historic perspective, interest rates are still low. That's the claim that a lot of people make. And it's kind of true, right? If you look at back in the 90s, people were paying 5 to 10% on their mortgage. If we're now talking about 1 or 2 or 3%, that is still a lot lower than 5 or 10%. So entirely valid argument to make. However, it leaves out a very important point or a very important piece of the picture, which is prices, right? Because if we're looking at this graph, for example, it shows that interest rates are roughly on the same level they were in 2012, okay? So 5-year rates are a bit higher than they were in 2012. We were coming from 1%, now we're at 1.4. 10-year rates, we're a bit lower than 2012, so we're coming from 2%. Now we're at 1.8, 1.9. But give or take, right, we're roughly in the same area than we were 10 years before. Okay, but what about prices? Because essentially, those interests, the interest that you're paying, those interest rates, always relate to the price that you're paying, right? Because prices have been rising 60% only since 2015 on average in Germany. 60% more, right? And that is on average. If you're looking at sought after destination or locations such as Berlin, Munich, Düsseldorf, Hamburg, Stuttgart, prices have probably risen by around 100 to 200%. So essentially, you are paying 2012 interest rates on 2022 prices. So you're paying yesterday's interest rates on tomorrow's prices, which is really not a good trade to make, right? So yes, interest rates nominally are still low in an historic context, but prices that you pay those interest rates on are at an all-time high. So the actual payment that you need to make is still much higher than it ever was before. So, and that is the full picture that you need to make, and that is why the argument look at rates back from the 90s is just not the right comparison. We do have further bad news, unfortunately. I know that it sounds bad enough already, but we do have some more bad news in store because prices or construction prices are on the rise too, right? So we have supply chain issues, we have inflation that is coming, or that is already here, right? And is probably going to be staying for a little while. And then we have labor shortages. It is super tough to find actually construction workers that actually do, you know, at the end of the day, you just need someone to build the homes that you're selling, build the flats that you're selling. And those people are quite tough to find at this point in time, right? So, and also if you look at the regulatory side, on the environmental side of things, right? So the environmental regulations have been increasing over the past 10 to 20 years. Think about solar panels that need to be installed on new flats and all that kind of stuff. Of course, that is really relevant and really important to do, but it comes at a price. It's not for free. So you have interest rates rising, cost of borrowing really high, and then you have prices or construction prices rising further, and hence less people are able to afford the luxury of owning a home, right? And that is just a development that we've seen over the past 6 months, and we think is going to lead to stagnant/flat prices or even declining prices in some areas over the next 2 to 3 years. It's not the end of the world, right? So the property market is not going to crash, but I think, or we think, that the times of price increases of 5 to 10% per year in places like Berlin or Hamburg are not sustainable anymore and are probably over for the foreseeable future. However, that doesn't mean that it's not that there aren't any investment opportunities in the real estate market, because if you think about it conceptually, you do have two sides of real estate, right? So you have the equity side, which is you buy a flat or you buy a house, or you have the debt side, which is you lend someone money to buy a house. And I think it's really interesting or important to look at those two sides of a real estate trade or a real estate investment in more detail. On the left-hand side, we have direct investments. So equity, you buy something and then you rent it out and sell it later. On the other hand, we have real estate financing, which means you lend someone money based or collateralized by real estate. Now, looking at the equity side, what do we have here? We have a property worth 10 million. You buy it outright. You buy it, right? You put down 2 million in equity, means you're borrowing 8 million against that property, which is kind of a regular setup. And then you pay 1% in additional fees from your equity too. So in effect, you have invested 3 million of your own money and 8 million that you borrowed from a bank. Now, think about a scenario where the property goes up in price by 20%. It's now worth 12 million. You have an 8 million loan outstanding, leaves you with 4 million in equity over a 3 million initial investment, means you made around 33% return on your investment, which is really nice. You have a 20% price increase and you make a 33% return. That's really nice. And that is a lot of the real estate magic of the embedded leverage that you have when doing real estate investments, right? You have a lot of leverage in those transactions. However, it also has a downside, because imagine this property falls now 10% in value. And 10% is not much, right? It's 10%. It's now worth 9 million, not 10 anymore, but 9. You have an 8 million loan outstanding, means your equity is only worth 1 million. You've initially invested 3 million. So you've lost 2 of your 3, means minus 66% return. So you lost 2/3 of your investment just by a price move of 10%. By the way, if someone told you that in equity in equity public markets, like you're buying a stock and if the stock moves by 10%, you lost 2/3 of your investment, you probably declare that person insane. But that is essentially what happens if you're in the equity position in this transaction, right? What does this tell us about the risk return profile? You do have unlimited upside potential, but you also have levered downside potential. So small moves to the downside can eradicate a lot of your equity relatively fast. So this is only a position you want to be in if markets are moving upwards. So if there's a price increase in properties, if the property market is going well, you want to be in the equity position to benefit of that full upside that you have when investing in an equity position. However, if markets are flat or even downward trending, you don't want to be in the equity position, because essentially you're at risk at losing a lot of your investment. The other side of the real estate investment world is financing or debt, where you essentially become the bank. If you look at the cap structure on the equity side, you have in green the equity part, and that's where you are if you do an equity investment, and in gray you have the debt part, so the financing part. And that's where you are if you do the debt trade. So basically, you become the bank. You lend someone money so the other person can go and buy real estate and assume the equity position while you are in the debt position. In this example, you lend 8 million against a property that is worth 10. So you have a loan to value ratio of 80%, which means around 20% downside protection. So the property price could go down 20% and you would still get your money back. Because of that protection, of course, the rates are a tad bit lower, meaning such a loan usually prices at 3.5% interest rate. You get 3.5% return on 20% downside protection. Meaning, looking at our scenario, this property goes up 20%, you still make 5%, but this property goes down 10%, you still make 5%. So you're a much more protected position than you are in an equity investment, but also your returns are a bit lower. There are, however, ways to increase your returns, and that is by assuming a mezzanine position. So that's a bit of financial engineering, but in effect, you find a senior bank that is lending 6 million in this transaction at an even lower rate. You find someone that is providing equity, 3 million, and you're lending 2 million in this mezzanine loan lender position. So you're junior lender effectively. For such transactions, your IRR is going to be between 7 and 10%, but you still have a 20% downside protection. So again, looking at our scenario, the price of the property goes up 20%, you still make 10%. The price of the property goes down 10%, you still make 10%, right? So this is a scenario, or this is a position you want to be in if markets are flat or downward trending, because you have downside protection at a relatively high fixed return that you're getting every year, no matter what. So essentially 10% interest on a 20% downside protection is just the position you want to be in when markets are flat or downward trending, because you have downside protection and because the fact that you don't have unlimited upside doesn't matter to you because markets aren't going up anyways, right? So looking at back what we initially established as the state of the market, this is actually the position that you want to be in and not in the equity position. You don't want to own properties at the moment. You want to be a lender and make 10% per year. Because this is all very abstract, right? Those bars really don't tell you much. I've brought an example of a transaction that we've done just this year, so a couple of months ago. And that is a real world example, right? It's not something illustrative that we've come up with. It's an actual trade that we did, and it really illustrates the beauty of being a mezzanine lender in this scenario, right? So this is about 2 fully rented multifamily homes in Berlin, really good locations, generate around 1 million in rental income per year, and hence are worth somewhere between 23 and 24 million. If you were to buy them outright, right? We didn't buy them. We provided a loan against those. If you look at the capital stack, there's a senior lender, local Volksbank, at 8.5 million euros. The sponsor has 7.1 million in equity in that property, and we've provided a 7.6 million loan against those properties, meaning that we have around 31% equity that come before us or after us in the cap table, meaning we have a 31% downside protection because we value at around 69% loan to value. So if you think about it conceptually, this property could drop 31% in price, or those 2 properties could drop 31% in price, and we would still get our money back. And the interesting bit is also the timing component, because that loan is only for 30 months. So you would have to drop 30% in 30 months in order for us to realize a loss, and that makes it even more unlikely. We're still making 8% on the loan. So we get 8% no matter what, as long as the property doesn't drop 30%. However, if you think about it conceptually, if the property should drop that much, we get to be the owner. So we take over the property and bought something at 70% that was worth 100 just a couple of years ago, right? So that's even the other interesting aspect. It gives you sort of an optionality on this property, but that's not the base case. The base case is this: we get paid our interest and we get repaid at the end of the loan. I think what's something that I really want to point out is the numbers in the bottom right corner, the return in different market phases, because it really shows you the beauty of the embedded downside protection of the structure. Imagine a scenario where the market stays flat. If you were to buy those properties, you would make 0% return on your equity. If you're a lender, you get 8%. If this property should drop 20% in value, as an equity holder, you would lose 2/3 of your investment, and LINUS would still make 8%. And if this property should drop 30% in value, you will lose 90% of your equity, and we would still make 1% and get our money back, right? So this really shows you the downside position. Of course, if you look at the flip side of it, the upside, if the market increases by 10%, the equity increases by 30%, and LINUS only gets 8%. But then again, that is something that we deem rather unlikely over the next years, right? That brings us to the question, why is the borrower doing that? Why is he paying such an interest rate? And I think the main reason for the fact that we're able to generate this outperformance is the fragmented state, or the fragmented niche in the real estate market, right? It is really an intransparent market. It's a market where it's all about having a network and having connections. It's not something that you enter easily. And that is, by the way, also an example that companies like LINUS have over individual investors, because we have a huge and vast network all across Europe in the real estate industry, whereas an individual investor that is just getting started is probably only going to be seeing the deals that everybody else passed on, right? So this market is really about having the right connections and finding the right players to collaborate with, right? And that is how we do realize those high rates, just because there is no transparency in the market. If you look at the other market participants, this is kind of a nice graphic because it shows you the wide amplitude, or all the different players in the market and how vastly different they are. You have mortgage banks, your traditional mortgage banks, that have access to a lot of capital, but are really risk averse. They would probably not have done such a transaction just because it doesn't fit in their policies. But they do have access to a lot of capital, which can be an advantage sometimes. On the other side of the spectrum, you do have crowd investment platforms that are really risk-seeking, that have a high risk affinity, but have access to very little capital. So typically between 1 and 5 million is what they can finance. However, unfortunately, that doesn't really get you that far in real estate finance, right? So they're kind of limited by their access to capital, whereas mortgage banks are limited by their risk affinity, or by their regulatorily imposed risk affinity. You do have institutional investors such as insurances and pension funds and all that kind of stuff. And you have debt funds and LINUS that are really opportunistic and really able to capture deals as they come up. And we do also have access to a lot of capital, which can be an advantage. We've paid out around 1.2 billion in loans so far. So that is quite a lot of money that we have access to. And that puts us into a position where we can act really swiftly and supply borrowers with the needed capital to do their projects in a rather short time frame, but then at rather high rates, right? So that's kind of the trade-off there. If we're looking at the process, I think, or at the quality standards that we have, I think the relevant graph is on the right-hand side, right? We've looked at around 8 billion in loans in 2021, which is kind of a significant market share in the markets that we participate in. I would say we see an awful lot of majority of the projects that get done in the markets that we're active in are ones that we've seen from the financing side, which gives us a lot of transparency in this market. However, from the 8 billion, we've only financed 499 million. We're still looking for the missing million, so 500 million would have been rather nice, but yeah, it's 499 million for 2021. So only a fraction of the loans that we've been looking at have actually been financed by us. So that tells you a lot about the quality standards that we have. If we want to take a quick look at the process that we follow, it's rather straightforward, right? We get a financing request, and usually within 24 to 48 hours, we're able to say if, generally speaking, this is something that we would be able to accommodate or that we would be able to finance. And then we kind of move forward from there, do the initial due diligence, make an indicative offer with a term sheet, have the first investment committee approval, have an independent risk valuation. So that's also very important. We do have an independent risk function that cross-checks all valuations and sees if the investment team did a proper job on the evaluation of the property or the project per se. And only after the independent risk function signs off, we're able to finalize the due diligence, get an external legal, technical, and commercial valuation again. So that's the third valuation that we're doing in this process. And then we're able to pay out the loan. How this sounds rather lengthy, but it's around 3 to 4 weeks, depending on the deal. We've already done deals in 2 weeks. Sometimes deals take a bit longer than that, so 6 weeks. But in comparison to traditional lenders that take months to follow that process, we're really, really fast, but we're not sacrificing quality, of course, but we're really moving swiftly, which gives a huge advantage to borrowers, and which is why they're able to pay us such interesting rates, and hence generate that alpha and outperformance for us and our co-investors. If you want to take a look at the projects that we're doing, feel free to sign up on our website, linus-finance.com. You'll then be contacted by a sales representative that guides you through the process and the individual projects that we have. If you have any questions, you always can reach out directly to me. Just give me a call or shoot me an email. Always happy to jump on a quick call to discuss any questions that you might have related to property investments or the state of the property market at the moment. Doesn't even have to be Linus related. Just give me a message and I'll try to help you out. I hope this webcast was helpful to you and gave you a broad overview of what the property market is looking like at the moment and what things to consider when investing into that market in the times of rising interest rates. Again, if you have any questions, reach out to me. If you have any questions that you want to ask now, you can always put them or drop them in the right box there anonymously, and I'll try to answer them right now. And hey, thanks very much for taking the time. I don't see any questions at the moment. So I guess we'll just leave it at that. Thanks very much for taking the time and have a great rest of the day.